Welcome back to another update of Smart Stock Sam. If you are really interested to make money out of US stocks, do not forget to subscribe and tap bell icon, because on this channel I deliver timely updates before crowd arrives. Alright, here we go.
The movies are back, the popcorn is popping, and the fans are ready to rally. Yet, despite the excitement, the scoreboard is flashing red. Right now, AMC Entertainment is locked in a high-stakes race against an $8.2 billion clock. While the headlines are busy obsessing over the latest Hollywood blockbusters, the internal numbers are telling a much more volatile and frankly, dangerous story. We are looking at a preliminary Q4 revenue miss and a 2025 net loss forecast that has nearly doubled to over $632 million. This isn't just a bad quarter. We are at a critical fork in the road where the company's very survival depends on a massive recovery in 2026. So, if you are holding shares or thinking about buying the dip, you need to know the truth. Is AMC stock about to explode or dive? Here's what the data says. Most people are looking at the movie posters, but to understand where this stock is going, we have to look at the ledger. And if you think the retail fans are still driving the bus, you haven't seen what the professionals are doing behind the scenes. The era of meme stock euphoria, where a tweet could send a stock soaring 50%, has officially been replaced by institutional reality. We are seeing a massive sentiment shift. Major players like Citi and B. Riley have taken a sledgehammer to their price targets, slashing them as low as $1.30. The reason for this pessimism is clear. They are citing lackluster revenue and a staggering 99% loss in value from the stock's all-time peak. The market is no longer trading on vibes or short squeeze theories. It is now trading on the harsh fundamentals of a business struggling to stay afloat in deep water. The smart money is betting that the nostalgia of the cinema experience isn't enough to pay the bills. But this bearish stance isn't simply hatred for the retail investor. When we dig deeper into the actual numbers, the problem becomes undeniable. The fundamentals reveal a massive hole that revenue alone just can't seem to plug. Let's look at the profit and loss statement, because math doesn't lie. The core issue is that current revenue is simply insufficient to cover the cost of doing business and service that massive $8.197 billion debt anchor. Think of it this way. AMC is running on a treadmill that keeps speeding up. In 2025, even with their best efforts to boost top-line sales, the net loss widened significantly. This is driven primarily by interest expenses and operating costs eating the company alive from the inside out. They are paying hundreds of millions of dollars just to service old debt before they can even think about profit. It's a vicious cycle. You borrow money to survive, but the cost of that money makes it harder to survive. Now, usually when a company loses money, the stock price drops and that's it. But for AMC shareholders, there is a hidden metric, silent killer, doing far more damage than the debt itself. This is the factor that should keep every investor up at night, unrelenting dilution. To keep the lights on and pay that interest we just talked about, AMC has flooded the market with new shares. In just 1 year, they increased the share count by over 33%. For the investor, this creates a brutal inverse correlation. Imagine you own a slice of a pizza. Suddenly, the chef cuts the pizza into 1,000 more tiny slivers. Your slice just became microscopic. As the share count rises to keep the company alive, the individual value of your equity evaporates. This dynamic causes the stock price to drop even on good news, because there is simply too much supply and not enough demand. Now, none of this fundamental gloom matters if the stock chart is showing signs of a breakout, right? Sometimes the chart predicts the future better than the balance sheet. So, let's see what the technicals are screaming. If you are looking for a silver lining on the charts, you're going to need a microscope. The technical indicators are confirming a strong bearish trend. The stock is currently hovering dangerously close to its 52-week low of $1.36. We are trading nearly 48% below the 200-day moving average. In technical terms, this is what we call catching a falling knife. While we do see a weak flicker of bullish momentum in the MACD, it is completely overshadowed by the dominant downward pressure. Scientifically speaking, The stock is in a confirmed downtrend with very little support in sight. If it breaks that $1.30 level, we enter uncharted territory. So, does any hope remain? Is this the end of the road? Well, not exactly. Management is pulling two very specific levers to try and flip the script. To avoid disaster, the company is playing a strategy game on two fronts: survival and innovation. On one hand, you have the survival tactic, a new agreement with noteholders to provide refinancing flexibility. This is crucial to managing that crushing $530 million in annual interest payments. It buys them time. On the other hand, you have innovation. Look at the recent partnership with Netflix for the Stranger Things finale. That event pulled in $15 million in concessions in just 2 days. This is a massive proof of concept. It validates that AMC can monetize non-traditional content, TV shows, concerts, sports, even if bondholders remain anxious. It proves the theaters are still culturally relevant. But let's be real, popcorn buckets and TV finales won't pay off $8 billion in debt. The real big payoff isn't happening this year. It's all about what's sitting on the 2026 calendar. If you are bullish on AMC, this is your holy grail. 2026 is the ultimate lifeline. The argument for the explosion hinges entirely on the upcoming box office slate. We are talking about heavy hitters like Avengers, Doomsday and Spider-Man, Brand New Day. With the Q1 pace already tracking 9% ahead of last year, the bull case is simple: a revenue surge so large in 2026 that it triggers a sharp reversal from this oversold state. The theory suggests that if AMC can just tread water through 2025, the tidal wave of 2026 blockbusters will wash away the red ink. But is a hypothetical movie slate enough to bet your portfolio on? We've looked at the debt, the dilution, the chart, and the strategy. So, what is all this actually worth? It's time for the final verdict. When we weigh the scales, the reality is stark. The structural headwinds, the $8.2 billion debt, the constant dilution of your shares, and the widening losses simply outweigh the strategic wins right now. While the 2026 blockbusters provide a lottery ticket for a potential explosion, the data currently supports a dive or a long period of stagnation. The math suggests that the hole is just too deep to climb out of quickly. For the potential investor, the explosion scenario is a low-probability event relying on an industry-wide miracle rather than the current company fundamentals. The data says, proceed with extreme caution. But what do you think? Is the 2026 movie slate enough to save AMC, or is the debt simply too much to handle? Let me know in the comments below, and don't forget to hit that like button if you want more data-driven truth.
Alright, that's the update. If you want more quick fact-based insight like this, subscribe and tap the bell icon so you don't miss the next one. Drop your thoughts in the comments, and I'll see you in the next update on Smart Stock Sam.